Hey, it's Rick here. It's Tuesday, August the 2nd. Hang on. I got a barking dog. Sorry about that. Babysitting the grand dogs, and they're not used to the place. So, anyway, where was I? So we're starting the beginning of a new month, and every now and then I like to sort of go back and take a look at the big picture. And what I have in front of here is a monthly chart. So every one of these bars represents 1 month, and it goes back roughly 25 years. Um, so get a sense of where we've come from. And like many of you have heard me ad nauseum before, one of my jobs, if you like, is to help you stay out of these nasty, nasty drops. Back in the dot-com bubble, when the market dropped, S&P dropped 50%. In the '08 banking crisis, it dropped 56%, and so on. So you get these nasty, nasty downturns. So I've talked about this so many times before, how to sort of prevent yourself from getting caught in this kind of a mess. And that's not the purpose of today. So, but it does show you how many times in 25 years we've had 3, 6, 7 very significant downturns. So that's what, one every 3, 4 years. So this last one that we had was actually fairly shallow compared to the two biggies, but did last a fair bit of time. It seemed more painful than what it was. So we were down about 27%. So really, where do we go from here? Where do I think the market's going to go from here? So let's just take these out of the way, and we'll scrunch this up a bunch so you can see it a little better. So again, these are monthly bars, whereas 2023 starts back here. So we've made a nice move since the beginning of the year. This little blip here, of course, is we're now into August. We've got 2 days of trading. So this is where we ended up in July. So if historically, August and September are among the worst, generally speaking, the worst performing months of the year for the market. And then October, November, December, generally speaking, historically, is much, much better. So with that in mind, here's, as you know, I like to draw pictures of what I envision what could happen, and then I sort of have contingency plans if things are going according to, as Minervini would say, is the train coming in on time or not? Is it coming in on schedule, or do we have to adjust? So here's what I think is a possibility for the balance of this year. So August, we're not off to a brilliant start, and I don't think it's going to get much better. So let's say we do something like this, and then September, we have something like this, and then we start to recover in October, and then November. And by now you see, I'm going to stop right there for a sec. For any of you that have done even a little bit of chart analysis, should be familiar with what's called a cup and handle pattern. It's one of the more bullish patterns that traders, investors look for. So what we potentially have here is the formation of a cup, like so. And then what potentially could happen over the next 3 or 4 months is we form a handle, which looks something like that, which then signals a potential buy for moves to new highs. So if that scenario does indeed play out, where are we? August, September, October, November, December could actually come back up and test these old highs, or the all-time high. As you know, I like to draw a line on my charts representing either a 52-week high or an all-time high. So the all-time high for the S&P is up here. Now, so where are we? Well, that's December. Now, when we get up there, this were certainly a stock and not an index, you would expect some resistance. But even as an index, there's probably going to be a fair bit of resistance up here. So it's quite likely if this scenario falls out, January and February could do something like this, just sort of March, stick around. And then in April, we'd be off to the races. Now, if this happens, well, first off, I'm going to get pretty bullish if this pattern shows up by the time August, October, November. By November, I'm going to get quite bullish, but only have a sort of a modest upside potential. And then if this happens, I'm going to get uber bullish for the balance of 2024. I mean, I'll be all in, and it's off to the races. So that's kind of what I'm looking at. That's my most hoped for scenario. But what we have to prepare ourselves for is, I mean, it could go something like this. So August comes down, September comes down. We try to rally in October, but you know, it just doesn't get anywhere. October, November, and December, we have sort of like this, some promise. And then we start the new year and, you know, something like this happens. So I don't think that's highly probable, but given, you know, inflation's still not under control, interest rates are still high, there's still wars going on, a potential for more. There's still crazy politics going on in the US. Last night, I was going to send this video out last night, and a couple of things diverted me from that. One was Trump's indictment, so I went down to watch the TV and see what's going on with that. And also I came across my newswire that the ratings company Fitch just downgraded the US debt. So I knew that that would cause an ugly day in the markets today, which indeed happened. Well, no, it wasn't that ugly. The S&P was down like 1.5%. Qs were down about 2%. But anyway, I digress. So this is not out of the possibility. So I'm always sort of looking at these scenarios and saying, how do I keep myself safe? How do I, you know, what scenarios do I get bullish and aggressive and I'm invested? And in what scenarios I'm in cash? It's better to, especially nowadays, you can get 4.5% or so. And that's even going to go up if the US debt's been downgraded. I think interest rates are going to go higher. So you get, you know, 4 or 5% on your cash. So that's a good spot to be. So anyway, that's sort of my my picture on the outlook. So I'll keep you posted on that. I did want to share one other idea with you guys, and that is for what, lack of a better term, I'll call the lazy investors. And this is those of you that normally would be what I would call an index investor, or you have a bunch of mutual funds or what have you. I'm going to use, I always refer to the S&P 500, which is essentially a mutual fund of the 500 biggest companies in the US. But to even get more narrow and focus, I'm going to zero in on the Dow Jones Industrial. And there's only 30 stocks in that group. And I've heard so many of you and others refer to the fact that when you're talking to your advisor, your own personal ideas, you don't want to take on, you want to be in safe stocks. Well, most of you have known me for a while, know there's no such thing as a safe stock. However, there are less volatile stocks. And I think if you're going to invest in a blue chip, only in blue chip companies with high pedigree, the best place to look is the Dow Jones Industrial. So these are the 30 biggest companies by market cap in the United States, and it's well diversified. You got technology, industrial companies, financial companies, and so on and so forth. So you have a good mix of companies. So I'm going to use that as a benchmark for a new idea that I'm going to work on it a bit more and flesh this out for you over the next week or two. But essentially it goes like this. The Dow Jones since January 1st is up 4.9%. Let's call it 5%. So as in any basket, you got some that are really doing well and you got some that are not so good, and everything sort of washes out, and that gives us our return of 5%. Well, what if we had a really simple way, I think a really simple way of just staying with the good. If you got a bunch of eggs in the basket, you only want the good eggs. You don't want any of the rotten ones. So how can we do something that focuses on the good eggs instead of the rotten ones? Because when you buy the Dow Jones, you're getting the whole basket. So this chart, and it may be hard to read on your screens, I'm not sure, but represents all the 30 stocks that make up the Dow Jones Industrial Average. And they're color-coded here, and I'm going to show you something in a couple more minutes, but make a little bit more sense. Or not. The color-coded green, blue, yellow, and red. So these charts show you the relative strength and the momentum for a group of stocks. Pardon me. Stocks with strong relative strength and momentum appear in the green leading quadrant. So that's this right now. As of right now, that's this batch right here. As the relative momentum fades, they typically move into the yellow weakening quadrant. That's here. So these ones formerly were up here, but are now weakening. And then if relative strength fades more, they move into the red category, which is lagging, the lagging quadrant, just down here. These are the laggards. And you can see, let's go back here. You can see that these are down, like Merck is down 7%. Travelers is down 11%, Chevron's down 8%, Verizon down 17%, Walgreens down 14%, Nike down 13%. So if you have a basket of eggs, throw these damn eggs out. You don't want any of these eggs. You want to be in the eggs that are growing, like the Intel's up 22%, Caterpillar up 17%, JP Morgan up 14%. Microsoft up 46, Apple up 49, Salesforce up 57. Those are the eggs you want in your basket. So I'm going to work on looking at this a bit more and designing a process whereby only once a month you pick three stocks and put an equal amount in those and leave them alone. We're going to set up stop losses, obviously, so you limit your losses. So that the trick will be, how do I, out of this batch, how do I find what I consider to be the best three? And then how, even more important, not so much how I look at it, but how you can look at something and say, these are what, in my opinion, are the three best. And then we'll track this. So I'll give you a little a teaser. It all revolves around this chart right here. Does that look pretty? But when I do a better presentation of this, this will all make abundant sense. So right now it doesn't. It's just safe to know that sitting here as of today in this leading quadrant, we have these stocks here like Caterpillar, IBM, Home Depot, and so on and so forth. So anyway, I won't belabor the point right now, but I'm going to work on developing a tutorial on this that, frankly, a 12-year-old could manage successfully. And I believe firmly that we could considerably outperform the Dow Jones Industrial Average as a whole, if you were to buy the whole index. So that's my project for the next little while, and I'm going to put my own money to test on this. So okay, that's it for now. Say don't get discouraged today. I won't go into depth about today. It was not a pretty day. Did get stopped out of a number of things. Basically, just crystallized some profits I had. No losses. A couple of them haven't hit my full stops yet. So, and most everything, the stops are at break even. So I'm not going to lose anything, but I'm now, I think, last I checked, I'm about 80% cash. So it's been quite a change in the last 3 or 4 days, but that's what the market is telling us. Just stand aside. And when things aren't good, you just stay in cash. Okay, talk to you soon.